Welcome back to another fresh episode of Attitude Makeover. I have with me Madhurima Agarwal. She's a director of the Accelerator program at NetApp and heads the global startup program for NetApp, and is also an investor in her own personal capacity in startups. Why is this a topic I picked? Having done more than 25 episodes, I felt one of the most important life skills is how we manage our own individual finances and how much we know about finance management. A major part of interest for me in the last couple of months has been on startup investment, and that seems to be growing in India as individuals invest in startups. So I have with me Madhurima, who is not just heading the Accelerator program for NetApp, but is also an investor herself. And we go through the nuances of the mindset. What are some risk attributes that you need to keep in mind? How do you evaluate startups to put in your money and bet on a particular startup? We get into the details of investing in startups. Having started her career as an entrepreneur, having a lot of passion in understanding finance and the experience that she's garnered over the years, she's established herself as a startup investor. In this conversation, we also go into expectation settings and also understand why this is not a space for everybody to play, and what are some of the risks involved, what are some of the research or the thesis that you go through or you put in as effort before you go through a serious investment. If you're like me, interested in understanding the startup investment space and don't know where to start, I think this is a great conversation to tune into. It brings out Madhurima's personal journey on, starting as an investor in the startup space, some of her failures, and what she believes are really important aspects that you need to take care of before you get serious into the investor space. As always, I hope you like this episode and look forward to seeing you more in my future episodes. Good morning, Madhurima, and thank you so much for joining Attitude Makeover as a guest. Thank you so much.
Thanks, Aujanya. Pleasure to be here.
It was a long ride, wasn't it?
In Bangalore, everything is.
These days, especially, the traffic is really caught up. And I think it is, with construction everywhere, it's very difficult to even find a Uber, I think, these days. So I wanted to get started with just my audience getting to know who is Madhurima. Of course, there is one professional side to you, but there's also a personal side to you, which is how we met, for example, was just by fluke, where you got into a call and I understood investment a little more, especially the startup investment space. Mm-hmm. So I first wanted my audience to get to know who is Madhurima.
Well, I think Madhurima is just a normal human being like you and everybody else. And someone who always enjoys trying out new stuff. Learning is important to me. So, and you'll see that, right? I've always experimented with stuff because that's the best way to learn, and burned my fingers, which teaches a much better lesson than any other way of learning. So that is there, and I think for me it's important that what I do in some way makes a positive impact, on the people around me, and that's my immediate family, the society, the world that I reside in. Not much probably that I can do, but in some small way, if I can contribute, then that brings me a lot of personal gratification.
A very humble person, I must tell you here. So today I thought, like we discussed, we'll dwell into the investor's mindset and really understand, as an individual investor, what is that journey like and how does one go about. But first, were you always a finance sort of background person, or do you come from a very strong finance background, or how did that happen?
Yeah. So I think, when I mentioned I like doing new things and learning, you'll see that. So let me take a minute just to share my, almost close to 20 years of professional journey. So when I first started out as an entrepreneur in the IT space.
Okay.
So I did my company which was developing softwares for the local businesses, very small, right? And then I did my MBA from IIM Ahmedabad, and that opened up a whole new world of possibilities. And that's when I had my first you know taste of what finance is like, really. So I spent the first decade of my career working for global financial institutions, and that comprised of both the buy side and the sell side, which means that I worked as an investment analyst at firms which write research, right, like Goldman Sachs and hedge funds. So you see these notes, right, that come out, financial notes on company coverage. So I used to do that. That's called the sell side. And then the buy side is the other side, where companies like Fidelity are there, mutual funds, which make investments on individuals' behalf, right? So I worked at Fidelity. And that, I think, gave me a very solid understanding of what the financial world is like, and a deep appreciation for why it's important to manage your investments. And it was a world, then I think still finance is still dominated by men.
Yeah.
And being, literally at times a lone woman there, gave me that added appreciation of why it's important for women to be part of this world. And I think that's where my finance journey started. And then, being part of the startup ecosystem again after this, I came back to that. That gave me a very solid understanding of how today, in this new world that we are living in, startup investing has become big, right? Because I could see firsthand how investors evaluate startups and what kind of returns they can get. And that propelled me to become an investor myself. So today I do some angel investing in my personal capacity. And in my professional capacity, I am the global head for the startup program for NetApp, which is a way for me to be connected with the ecosystem, the startup ecosystem, very deeply. It gives me an opportunity to connect with a lot of founders and understand the role that capital investment plays in growth of these startups, right? So all of this has really helped me frame my investment thesis and understanding. So that's in a long way is my love for finance and understanding where it comes from.
But that also brings out the exposure you had to when you talked about Goldman Sachs and the kinds, the buy and the sell part of it. It gives you a good perspective of what to invest in, what are trends, what are big pictures, what are mega trends, and the research associated with it. Whereas this end of the sell part gives you a good picture of how these investments are made, and a startup background gives you a very good picture of the startup mindset and how to evaluate a startup itself, right? So that way, am I right in saying it's a pretty holistic perspective you come with?
I would like to say so, yes, but I still think there's so much to learn about it. It's an ever-changing world, right? So while yes, the framework remains the same, but what is happening in the macro space, what's happening in the micro space, and that is always changing, which is why it becomes more interesting, because it keeps you on your toes. You always have to learn, always have to read, which is very important, I think, for any investor, right? You have to be abreast of what's happening in the world. You can't be just in your own shell and think that, okay, I think this is going to work, so let me invest here. Wishful thinking. Sometimes it works, but more of a fluke. So it's always important to do one's research and stay connected.
One of the things when we were talking earlier was you mentioned how the investment space has changed. Earlier there was a seed A, seed B, but there is pre-seed. There's even like an idea itself gets pitched as a startup and funds are being raised, and then the company starts evolving. What's been your experience as an investor? Do you invest? Can you give us a lay of the land of how it is today versus how it was before when you started, and where is it trending towards?
Sure. So, see, in the if we are talking about the startup investing state, that world, right? I think specifically in India today, it is a great time to be an investor and also to be an entrepreneur, because both have matured to a certain extent compared to what it was few years ago, right? And I've seen it evolve over the past 8 to 10 years very closely, and hence I think it is one of the best times. It'll get better. Of course, as with any other industry, there are a lot of risks that are there, and it ebbs and flows. But if I look at the past couple of years, especially during COVID times, and I don't think I'm telling anything new here. People who read would know this about this. We've seen a lot of investments that have actually generated return and given exits to investors during these past 2 years, which means there's a lot of euphoria about that. Okay, this is real. It's not just something that will happen someday. It is happening. A lot of people made a lot of money, and hence, as is natural, you now see a lot of retail investors coming into this. Retail means like individual investors who have started thinking about investing in startups, which earlier was not the case for various reasons, right? Primary among them being, one was this was very restricted access. You could not get access to these deals in the first place, and if you could, the ticket size refers to the amount of money that you need to invest, was too high. But now what has happened with increased interest from individual investors, the availability of capital, that itself has increased, right? There are more people who have more disposable income willing to take risks to invest in these startups. It now made sense for a lot of new companies to come up with products that can offer a platform to these individual investors to invest in startups, right? Which are called angel platforms. There are many that are there, and I'll probably do injustice to those I don't mention. But some of the top names that come to mind are Angel List, Let's Venture, and One Crowd. So like that, there are many of these that allow people to just get in and invest with a starting investment of just 3 to 5 lakhs per startup, which, while not less, is still fairly affordable. And somebody wants to dabble in this space and take an informed risk, calculated risk, it's now available. So that is the big change that I have seen happen, like much more participation, widespread participation that's happening. And I think in future this trend is going to grow stronger, just like we saw the growth of mutual funds in India, where people kind of started to understand what it is to invest in capital markets through the mutual fund route. We are seeing these aggregators which open up deals, and then people can put in small amounts of money and get a share of their investment done through this, which is as a mutual fund industry mushroomed. We'll probably see this going up.
Are there industries or sectors that are really game changers in India the next couple of years, Madhurima?
I really don't think I can comment on that, because this industry is so fluid, and it's so many things are unexpected. You just don't know where the next big thing is going to emerge from, because a lot of it is influenced by what happens in the macro segment, right? EdTech became very big in the past 4 to 5 years, just because the way the scene unfolded in education. More people became conscious. A lot of people had to do school from home, which means that all these platforms became more, had a wider customer base. Health tech grew like crazy just because of what was happening in the world, right? With the focus coming back on health. So I think one area which I personally think might be big is job tech. Now that a lot of people are getting access to education, to skills, and their growth happening in the industry, what is lacking right now is a way to match the skills to what is required, right? So job tech is an area where companies which might skill the labor and also connect them to the companies which are looking for that labor. So that is something which I would bet on.
Got it.
Of course, other than these health tech which is there, And if I look at a wider, segregation between B2B and B2C, which is business to business and business to consumer, in India, right, especially I think the B2B market has grown very rapidly because I now see a lot of seasoned professionals starting up, which means they understand the world that they are planning to cater to, the customers that they've been that customer themselves. They understand the pain points, and if they are starting up to create solutions for those problems, then I think the chances of success is much higher. Also, the capital requirement for B2B is much lesser compared to B2C, right? Because the marketing costs minuscule compared to what would you need when you are advertising and doing marketing very aggressively. So B2B is more of my favorite. But of course
I as a someone sitting on the other side and who's just started, I do think B2B is a lot more easier as well. I'm not lightening the effort involved, but then in B2C, it's first the customer acquisition, whereas here you build the product and you start showing your success. And I might be wrong here because I'm just 3 months old. But is that one of the trends you're seeing as well?
See, for entrepreneurs, B2B is tougher initially. Why? Because they have to invest for that 1 to 1.5 year period where they are just building, and there is no apparent success, right? There's no customer that they've been able to acquire, so they have to invest the time upfront to build the product. And only once it's up to a certain standard with anybody, especially in B2B, we even willing to try it. B2C, you can start your trials, customer test very quickly. So that way it's tougher for a B2B entrepreneur, I believe, in the beginning. But yes, once you've got the product done, you've got a few early customer wins, then it's much easier to scale.
And is it easy for us as Indians, as individual investors, to invest in the global startup as well? Or is this more limited to just the India investment?
Yeah. So I think, what needs to be kept in mind is that if you're investing in global startups, even SEBI has certain rules. Even for investing in India, SEBI has certain criteria that one needs to fulfill because they do want to protect the investors' interest, right? And ensure that they are aware of the risks that they are undertaking by investing in startups. And which is why there are certain regulations that if I remember it correctly, in India, if you want to invest in Indian startups, you need to have a net worth of 2 CR plus you need to be either a person from the startup ecosystem, a founder who understands, or else a corporate professional with at least 10 years of experience. Right? So which means they don't want people who don't understand this space, the risks that it has, and just jump in and lose their money. For global, you have to be an accredited investor, which has its different set of guidelines. Right? I think it's you should have a net worth of 5 CR or more. I'm not very sure what exactly it is. So that way is investing. If I would say, if also the quantum of money, right? Because valuations usually are higher when you're investing in global startups, just because of if nothing else, then at least the currency conversions that kick in. So if it's an individual investor who's looking at starting up, by investing in this startup ecosystem, better to try out, and learn by investing in Indian startups. But of course, again, there are platforms which offer both global startups and Indian startup deals. So one can go for that.
And one of the things I was reading, Madhurima, was you have different ways in which disruption is happening in the angel investment as well as the VC firms itself on the main fundamental framework of how they function itself. Like I was reading about AZ16 versus Tiger versus some of the others. And then, of course, there are companies which have these accelerator programs as well. Can you give us a flavor for how that is, and what are some things as an early investor one needs to be aware of when it comes to, like you talked about angel list, one crowd. What are some things I need to check before I say, okay, I'm going ahead with this investment body?
Yeah. So multiple questions you've asked in one question, Sajanya. So okay, let me try and break it up and answer.
It really shows a naivety on this side.
No, it just shows these are the kind of questions I myself faced, right? When
Yeah.
I was when I started to invest personally 6 to 7 years ago, and the start was nothing to be happy about.
I want to know more about that as well.
Yeah. So, see, I think one thing that we need to keep in mind is angel investing is very different from VC investments. VCs do it as part of that's their core business to invest, which means they have the time, the energy, and the resources to invest in deciding where to invest. Right? As an angel investor, the assumption here is if you're an angel investor, you probably have something else which is your full time occupation. And you are angel investing because you're either passionate about it or for whatever reason. And if just one disclaimer here, if your reason is you want to invest to make money, probably not the best way to invest.
You've told me this earlier as well, and
Yes.
you've told me to stay grounded in terms of expectations.
Yeah, see, what happens is we all hear these stories, right? That this startup's valuation became 10x, 100x, whatever x, right? And you're like, oh, I'm missing out by not investing or being part of this investment community. If you solely think that that's the best way to make money, probably it's not. Because we all, and not just in startup ecosystem, everywhere, we all get to hear about the success stories. We don't hear about the ones that failed, right? Nobody talks about the failed investments. They're like, okay, I don't want to talk about it. Whereas it's very important that, and what I told you, you have to stay grounded.
Yeah.
Don't invest just for the sake of making money. You probably have other avenues to make more money than by investing in startups. But invest if, while you might end up making money, if you are passionate about learning about new things, if you're passionate about meeting entrepreneurs who might just come up with something that can change the world tomorrow, right? If you're very passionate about experimenting, trying new things, then invest. And of course, you should have money that you're okay to spare. Money that if you lose completely, it won't change anything for you, in the sense that it won't hurt you, right? So that's important. Invest only for these reasons. And if you end up making money, that's great. That's your bonus, right? Sorry, I digressed.
No, you didn't.
So yeah. So in fact, when I made my first investment, I think the company folded within 3 to 4 months.
Oh, 4 months.
Yeah. Less than 6 months for sure. And I was like, what just happened? It hit me hard in the sense that I was like, I thought it was going to be a blockbuster and would make me, turn my lakhs into millions and billions, and it's like zero, right? That's when I took a very hard look at this myself. Why did I invest? Did I really understand what I was doing? Where did I go wrong in my thinking, right? And that's when I realized there's tons of stuff I don't know about it, right? What I had done is I had heard the idea, okay, AI in health tech, which is just going to change the world, and they'll use AI, they'll figure out what's wrong with the world, everybody will get healthy. The entrepreneur said that he's great with this, he's got a great team. And a couple of my friends were investing. I said, okay, did I do any financial due diligence? Did I do any way to check as to how far the entrepreneur was in his journey? How true were the claims? Or was it just, he was talking in his echo chamber and I just fell for it? Lots of stuff that one needs to assess and understand. So I just stopped investing after that and spent a good chunk of 3 to 4 years trying to understand what this industry is. I worked very closely with founders, right? Understood what their struggles were, observed how some companies did better than other. and created a paper portfolio. So if I like some company, instead of putting in actual cash, I would just put it down, say that okay, I've invested, let's see how this pans out, how quickly this company falls. Right. And then kind of just like we play stock market games, right?
Yeah.
Simulation, do that. And over the years, when I realized that probably my bets are going more right than wrong, is when I started to put in actual cash.
Got
right?
it.
Which meant that I could do two things. I could either look at the companies I could have invested in and could have made a lot of money, but decided just to do it on paper and lament, oh, I should have just done that. Or, the other thing which I did is, okay, now I think I understand this better than before, and probably now's the time for me to actually jump in and start making these investments real. So, that's what I see very common across all my investor friends, right? They have an anti-portfolio, which means startups, deals that they passed in, for whatever reason, they maintain that, and it's a learning thing for them. Okay, this is how I thought, and this is how it panned out, which is different from what I had expected, and we all learn, right? So, yeah.
What I'm sort of drawing a parallel with, I play poker, right?
Yeah.
So in poker also, you watch your game, you watch how the bets are, you watch how the hands pan out game after game, and how you've been betting, and gradually you start either recording on your device your moves and what happened, or you make a mental note of it and reflect back. But that is how you get better and better at the game, which is what you're also talking
Exactly.
about. Yeah. But I have one counter question here. So when you talk about these investing companies like AngelList or OneCrowd, they offer a product. I mean, if I call it a product, which is they do the assessments, they do the evaluation, they evaluate the founders, the team, and the technology bit, and then bring select set of entities on to a review for the investors. Beyond that is what you're talking about as a research, or is there some way I can tap into that and complement that with my kind of research?
Yeah, see, what they do is hygiene. And by investing through these platforms or through these networks, you kind of have some sense of, hygiene checks having been done. Because as I said, as an individual, it's very difficult to invest that kind of time researching all the companies, all the startups that come to you. Right? But what I am talking about is beyond this, your own research, because you get, let's say, a deal every day. How do you decide which ones you want to invest in? What fits your investment thesis? So as an individual investor, I think everybody needs to have their own investment thesis. And what is an investment thesis? It essentially is just a set of points that you note down, saying that I am comfortable investing in a startup if XYZ, these are the conditions that are met. Right? Because a lot of times you have to eliminate the deals, right? If you get like deals worth 100 crores and you're going to invest like 5 crores, which are the ones that you should invest in? That is where your own research, your own gut feeling about an investment comes in. And a more structured way to do it is have that investment thesis. So personally for me, it's very important that, I have that belief in the founders. So a high weightage is given to what and the word here is feel about the investors, about the entrepreneur. When I hear them talking about it, do I get a sense of, they are the best team to solve for this problem? Or probably they are just like any other, right? Those kind of things. For me, founders' pedigree is also important in terms of, where have they studied, where have they worked, what kind of networks they have, and is that going to help them gain customers for the product they are building, right? So in that sense, also I tend to go with deals where there is already one VC who's investing, because then I kind of am, more sure of their next round, that if somebody with deep pockets is already investing, it'll be easier for them to raise their next round, which is important for business continuity, right? So those kind of things, everybody should have the investment thesis, and also have in mind what kind of risks are they willing to take, right? If you have spare money worth 10 crores, let's say, then the kind of ticket size and the number of deals you do will be vastly different from someone who's looking at investing 1 CR, right? So like that, you have to follow your own discipline, have your own discipline, and just invest accordingly.
Got it. And Madhurima, here I want to step back. Before you got into, because one of the disclaimers you had was expect nothing to come out in the first 3 to 4 years, right? Because this takes time for you to evaluate. How does one, my audience is mostly in the 25 to 45-year-old. I have some in the 45 plus as well. But for someone in that age group, you're still sort of the breadwinner, you're still doing your savings, you're figuring out the finances. For that sort of a audience, how does one go about planning in such a way that while you're saving in your mutual funds or your other more traditional saving mechanisms, you're building your ability to evaluate here, so at some point you have that spare money to actually start really investing. And these returns don't happen in 2 to 3 years, they happen in a much longer period. So how does one go about, especially women, how does one go about really planning this? Because that's a big mindset shift itself, right?
Yeah, so see, first thing, not everybody needs to invest in startups, right, to make money. I'm repeating myself, but that's important to know that, right? Why are your reasons? What are the reasons that you're wanting to invest in startups? And of course, there are a lot of checks and balances in place, regulatory ones itself, that you cannot invest until you have fulfilled those criteria. And this is all to safeguard your interest, right, and investors' interest. So to your question about how does one, two parts to it. How does one do the research? And the second part is how does one build that corpus, right? Now, research you can start doing. Start reading today. Start following, just think, if you had that spare cash, where would you invest? And then start following that startup's journey. Read about it closely. See what they are changing and how that is impacting. Now, the thing with startups is that they are all private, right? They are not public. So you have very limited information. So that's a challenge, but you rely on whatever's available, right? On the and then over time you'll get a sense of how you're doing, right? Whether you're betting the right horses or whether you're thinking which is different from what the reality is. On the second part, which is about how to build your corpus. Now, I don't know. I wish I had a bigger corpus.
Don't we all?
So yeah, just save. I mean, that's I think we, as Indians, we are taught to save right from childhood, right? There has been, at least when I grew up, there was a lot of focus on, saving money. So that you can use it when you need it. You don't have to spend just because you have it. And in startup investing, whenever you invest, as I told you earlier, right, it's an illiquid investment. Contrary to mutual funds, once you've invested in a startup, you cannot withdraw the money at will. Especially when you're investing as a group, right, through these platforms or networks. Only when the lead investor or 75% of the investing group approves exit and you have an exit opportunity, can you get your money back.
See, I didn't know this till you actually told me this last time, because I was like very thrilled and kicked about the whole thing. And I started attending the conversations. And then when you told me, I was like, I went back and read about it, and I realized that's a big difference between how we do our other savings to the exit. Exit is a big part of how you plan your investment itself, isn't it?
So this is more illiquid than real estate investments. Because in that, at least if you want, you can do a distress sale. Worst case, you want the money, right? And you have a buyer, of course. So here also, you need to have an exit opportunity. Somebody who's willing to buy your stake in the first place, and then, the rest of the things coming together. And as I said, there is hardly any information.
Yeah.
So it's like, you just put your money in, and I shouldn't say it, but it's like, it's gone in a black hole because you don't know what's going on till you get that update from the founder, which most often in early stage investments is what I'm referring to here, is probably once in 6 months or once a year, right?
Which by then they would have closed as well.
Hopefully not.
Because your first
Well,
experience was
if
4
they've
months.
closed, you'll know sooner. So sometimes no news is good news.
Yeah.
But you don't know, right, how it's doing. So sometimes when you're early in investing, you kind of tend to get anxious. And you're like, what happened? How many customers have you got? And you cannot go after an entrepreneur requesting for reports on a regular basis, because that takes them away from the business if they do that, right?
Yeah.
And you don't want that as an investor. You want the entrepreneur to focus on the business. So these are some of the, things, as I said, it's very illiquid. It's kind of, you don't know what's happening, which if you're a person who's prone to anxiety, can get very anxious. So only use the money which you don't need, which you won't notice if it disappears, right? So your question of how to build that corpus, other ways, but not by investing in startups. Of course, once you get your first exit, which hopefully you hope is like a big amount, it kind of gives you that corpus or that wallet for future spend, right? So you will see a lot of these well-known angel investors, or the top angel investors, the marquee angel investors. They are usually people who've had some very early successful exits, and then they rotated that money well. And as is the case in finance, always, right, money attracts money. If you have money to invest, you make some. Another thing, in startup investments is you should not invest in one or two startups. You should always have a portfolio. Because if you look at stats, 50% of your startups are likely to be just able to manage, right? What you invested is what you'll get back. About 25% will just shut shop. You lose all the money. But the rest, 25% will give you that return, which will make up for all the rest, right? So if you've just invested in one startup, the probability of you losing it all is much higher compared to that one being, you being so great and so lucky that you just made that one investment and it gave you a multi-X return. Which is why I have a portfolio, as we say, don't put all your eggs in one basket. So don't invest all in one sector or, whatever you call it, all of one kind. Just diversify in terms of stage, in terms of the sector, in terms of, geography, whatever. But have more startups in your kitty, especially when you're early, so that you get some wins, which then help you have that spare money to further roll that money into more startups. And then
which also means, so one of the things that really fascinated me when you introduced this whole thing was the kind of exposure I get to build for myself. That learning process is really incredible. But it's very time consuming. It's and like you said, the information is very sparse. It's not available. There's probably research on what industry vertical trends are happening or mega trends and India specific trends, but specific to a startup, what's really happening there, who are these founders, what's happening there. That's more a networking thing as well. Have I got that right?
Yeah, today it's much easier for people to be part of that network though, right?
Okay.
So it's not so much a close network because through these groups, angel investing groups or platforms, they kind of bring those founders, have those calls with the founders. You can hear them talk, you can ask them questions. So that ways it's more of an open network compared to what it was a few years ago. But yeah, that thing about not having that information always handy, that stands true.
Hmm.
What does happen though, if you're an individual who is adding value to the startup in ways other than just giving them money,
Hmm.
right? As in, let's say you can connect them to potential customers, you can connect them to potential employees, or you can give them guidance on what is expected to happen in their industry because you understand that very well, then they will stay connected with you. They'll come to you for advice, right? And obviously then you have that real chance of contributing to their growth, which means you're part of their journey and you know what's happening. So and that's the kind of investors that entrepreneurs love, because money today
It's still
is
managed.
available, in plenty and good. There's a lot of money which is chasing these good startups. And startups, the founders today are more educated. So they are not looking at just getting money. They are looking at taking money from the right people who aid them in their growth rather than detract them by just asking them questions which don't add value, right? So, yeah, it's complicated, but
No, it is I think it's very important to understand. You started off with you need to have a day job, and this is like a before you go to bed research sort of a thing. But it's not as simple as that. It's not just your research, and it's not just, oh, I have spare cash, now I'm ready. It's also in order to sustain it and to go back to your whiteboard or paper where you're testing some of this, it's also what you bring to the table, and that is where you get connected and stay connected to see how is it progressing, to evaluate your own progress, which means it's not just like a bedtime journey.
No.
It sort of is something which is where you're saying anxiousness sort of builds. Have I?
that's right. That's why, Sojana, again, the same thing I said, right? You should invest if you're someone who enjoys learning, someone who enjoys experimenting, because that's when you'll truly enjoy this journey of investing. Otherwise, it will be more difficult, will bring you more troubles rather than comforts. So yeah, it is not for everybody.
No, and that's very
Yeah.
important to understand. Like, what kind of mindsets would really enjoy this. Like, for me, I found it very interesting because it has multiple nuances. One is, of course, I'm not rich with money, so that spare cash anxiety bit stresses me out. But it also means that because you're putting in that kind of effort and time and money, that research that needs to be done, the connections, and how you can give back.
Yeah.
And thereby, to your earlier point of who is Madhurima, I like doing my bit for the change, for a more positive impact. I think that is what is attracting me. And in that process, I'm also learning as an individual, growing, and my financial acumen is gradually getting better and better and better. And that is a good win-win situation. Is that a mindset that people
Yeah.
come with?
You got it right. Yeah, that's how it should be. Does everybody come with it?
No.
No.
Yeah.
But and I think that's where it helps. You don't start off like that always, but once you start and you interact with the other folks who've done this, you grow as a person. You grow this mindset. So you don't have to have everything, right at the beginning. But those are things that will help you on this journey. Yeah.
But now I'm going to go into more details of understanding this investment? Because when I got in, there were these subclasses of exit and all that. I really didn't know till I had coffee with you. And I think that session that we had was really helpful in understanding how this whole system works. Like if we ran through one crowd and how one crowd works, what's the frequency, what kind of validations is done by one crowd, and what kind of startups are coming in, what's the entry criteria, what is exit, what are some KPIs we need to look at. So a lot that we had as questions I had as questions in that 1 hour. Can you give a perspective of, step back to that conversation and give a perspective of what are basic things I need to understand before picking a firm and before taking this plunge, understanding the investor space completely?
Yeah, that's a very difficult question but as I said, right, any startup that you're looking at investing in, you should be clear in your mind as to what you think are the success criteria.
Okay.
Right? And that is different for each individual, Saujanya. Right? Like for me, I did share, right, what's my investment thesis. Similarly, everybody needs to build their own investment thesis. If all of us think the same, then only a certain set of founders will get funded, right?
Yeah.
But everybody does, because everybody sees a different opportunity and evaluates it differently, which is why everybody will have a very personalized investment thesis. But it's important to get that in place, right? For example, for me, as I said, founders are one of the most important criteria, whether I feel this is the best team to solve for this particular problem, or if need be, will they be able to pivot and do something else. So like that. And I think in early stage investing, I will not be amiss if I say that for most investors, founders are key. That's the most important, because they are running the business. It's their business end of the day. We are just like facilitators. So do that. Then there is the second thing that I look at is in terms of what is the problem they are solving. Is it something which is real, or is it something which is just perceived and is potential? And I do that test which I call whether it's a vitamin or whether it's a painkiller.
Tell me more.
So it's like if you have limited amount of money and you go to a chemist and you need both, which one would you buy?
Painkiller first.
Exactly, right? Because that's solving a real need that you have today, whereas a vitamin is something which might not help you, right? Same way for a startup problem. So that's the same way I evaluate a problem. Is that problem real? Will it solve something today? And is there someone who will be willing to pay for it because they need it, versus someone who might pay for it because they want it, right? So if it's a painkiller, likelihood of being a winner much higher, right?
Necessary versus sufficient conditions.
Exactly, right?
Yeah.
So it's that's the second thing I look at. What is the problem they are solving and how real it is? And then of course, the market size. Why market size? Because a lot of problems are real, but they impact only a very small set of people, which means that market will get saturated very fast and the scope for growth will be limited. Which means that for them to get the next round of funding, future rounds of funding, not just next, will be tougher. Because how do you look at a startup valuation, right? You, as an angel investor, one invests very early. And then one makes money when somebody comes in at a later round with a much higher valuation. And why would and that's typically a VC institutional investor. Why would they come in? Because they see huge potential in terms of the revenue or the profits or the valuation that startup can get, which will happen only when the market is big enough, right? So for an angel investor to be able to have a profitable exits, it's important that somebody comes in at a later round and is willing to pay much higher for them. So, and a VC does that only if there is a big market, huge market. For them, it's very important.
It's a scale that matters.
So what is the kind of scale that that startup can achieve? So if it's a limited scale, then I probably will not make enough on my investment compared to another deal, which can has the potential to grow much bigger, and thus the likelihood of it generating a higher return is more. So those are the three things that I think are basic checks that one should look at, and then additional criteria one can build in the investment thesis as per their.
I've seen, and so I've been part of this IIT cohort, I was telling you, the startup cohort, and there they bring in a bunch of startups before you take it through these VC investors and angel investors. What I've seen there is also there are these projections of sales. We've got X number of customers growing at Y percentage. The ARR rate is so and so, velocity is so and so. Do you, as an investor, need to understand some of these sales and marketing growth bit as well?
Frankly, I don't give much credence to the numbers that are put there, because it's all in the air, right? There is so much that can influence that. It's all assumptions, end of the day. But what is important is to see how big is the entrepreneur thinking. Are they even aware or conscious of the potential their product can have? Because it shows vision, right? How how aggressive they expect themselves to be, and how real that is. So to simplify it, let's say I am someone who understands, let's say, the tech space very well, right? And I don't understand consumer retail as good as well as I understand tech space. So if I'm investing in a company in the retail space, will I be the best judge of the numbers that they have put in there? Probably not, right? So what I should do in that case is I rely on the people who understand that space, which is why for me as an angel investor, it works better to invest as part of a group, because then I draw on the collective wisdom. So if I see that a vice president, just taking random, a vice president at a retail company is backing a startup in the retail space, then my conviction will be higher compared to having a tech leader back that company, because who knows the company better? Who knows the space better, not the company, right? So then I just say, okay, I respect this person's judgment. He is willing to back it. Everything else looks fine. So I will trust his or her judgment and, probably invest based on that. So, yeah, we don't need to understand all the numbers, but a basic level of understanding is needed, right? If somebody is showing that they expect their revenues to grow at 25% year on year, whereas the industry or the market is growing at 2% year on year, right? Then you need to ask that question: what is bringing in? What are you doing differently that is causing
that kind of a growth?
Yeah, and if you're satisfied with the answer, good. If you're not, then question that.
So what you're also saying is, as part of your research, you should have a fair understanding of how that industry is growing, where the growth is happening, are there specific segmentations that are really working out. And so when this presentation is going on, you have your thinking hat evaluating it in the right way and questioning some of these, which again goes back to really grabbing that knowledge and building
See,
that knowledge.
It's all about learning.
Yes.
And I personally, when it's a new space, then I just listen to multiple pitches and see what different people are saying about it. And if I see there is a consistency in certain things, then I know that's probably an industry standard. And then I'll invest in the nth startup, not in the first startup in a new space. So yeah, that's how.
What's the NH?
NH, as in like, probably the 10th or the 15th,
Oh, okay.
not the first, not
Okay.
the first startup.
Okay.
After I feel that, okay, I have some understanding of
Yeah,
this,
yeah.
which is where, the learning for an individual comes in, because you're pushing yourself.
True.
And how many tech startups will I invest in? I need to invest in something else. So I need to learn about it.
True.
Yeah.
True. Now, one of the things I also read when I started doing this early research on the companies itself was that you have, on one hand, startups like your, unicorn sort of things, which are just starting. And then the other hand, you have the big scale startups. In the middle is companies like the JCPenney's, which sort of, they call it the middle bulge or something, where they say, don't invest in these, be careful of identifying these. How does one go about really identifying what I'm talking about? I think they call it the, what is it I had read? It's called the startup, some bulge. I'm forgetting it. On one hand, you have like the premium accounts where there's heavy investment. It's a niche sector with heavy investments, and this would be like the Chanel's and in the retail space sort of thing. On the other hand, you probably have the Walmarts and the Targets, which are really, again, got the right investment, it's at scale, it's got the massive growth potential. And then you have the middle sector. And I read this in the context of retail sector especially, where they saw this massive trend transformation where these two extremes survived, but the middle bulge, a major part of it was just difficult to survive and transform, and they just started to die off. And so one of the things that came up in that article was, you should know how to identify this middle bulge.
So yes, if I understand correctly, what you're talking about is companies that are early with very high growth potential, companies which already are market leaders, and then something in between. So if you're talking about startup investing, then this really doesn't apply that much, because everybody claims they are in that growth potential stage, right? And in that also, the unicorns are the ones which are already the top, which already have more than $1 billion in valuation, are called unicorns, which is what every startup aspires to be when they start out, because that's like a crown you get to wear, right? So I think when an angel investor goes in, they always go in for early stage, because that's the kind of ticket size. That's when you're an angel.
Yeah.
So
no, I'm with you there. I need to. I think it's in my phone. We'll come back to that. But it basically.
But if you're stuck in the middle ones, which are going nowhere, might as well just get an exit if you can.
But how do you recognize these as the middle ones? Like in a class of 30, how do you recognize these are the top fivers? These are the bottom. I mean, these are the next batch.
It's difficult. I don't know, and I think that also amounts to everyone's, personal aspirations. And I say that for me, could be that a company which is growing at a rate of 5 to 10% every year is comfortable. I'm okay with that. Whereas an aggressive investor might say, no, anything short of 20 to 30% year on year is not worth my time and money. And someone might be like, this is, it's even if it grows as like 2 to 3%, I'm happy with it, because it's a volumes game for them, right? So very difficult to say who's what, because it's your personal portfolio that you will look at, right? Everybody wants high growth, right? I mean, no doubt about that. So yeah, sometimes I don't know. I think it's very individual. What are you looking at from that? And look at your own portfolio.
I'm a little confused there. So I'm going to ask you a couple more questions here.
Sure.
Because on one hand, we have that exit bit, right? Because let's say my outcome, when I start building my paper research is that I would like to invest in 5 to 10% growth, and I'd like to invest in the criteria that we just talked about, and these are the sectors I would like to play around with. Now, when I actually start investing, I can't exit when it hits a 5 to 10% because exit really happens when everybody exits.
Yeah.
So then that's not really a great outcome to start off with as, okay, this is how I'm going to identify my portfolio, isn't it?
See, welcome to the real world, right? Which is why I said, not everything will go as you expected it to. And so you have to be comfortable with that risk.
Do you tier this in that case, Madhurima, to say out of the 10 investments I'm going to make or 5 investments, I'm going to put my 20% eggs into this 5% return?
No, see, when you're investing, you want to invest 100% in high growth. You don't want to invest anything which is
so first focus on the growth range that you're looking at.
That's because it's all expectation. If you expect it to grow at a moderate rate, then probably it will end up somewhere lagging behind. You have to at least aim for the sky, then you reach the mountain. It's exactly that, right? You have to invest expecting it to show high growth. But probably because of real world scenarios, it might not be a sustainable high growth. It might, 50% might actually turn out to be medium. 25% might be zero or negative, and for that 25% you expected 10 to 20 will show you 100 to 200. So it's expectation versus reality. You should always invest where you expect it to be high growth.
Got it.
But,
so
but be prepared that this is how the outcome might be.
What kind of conversions are we talking about? Is it 1 in 10 convert into a high growth, or 1 to 100, or 1 to 500?
Yeah, usually people see that if you have a portfolio of 10 startups, and I'm just using 10 as a easy to understand number, 5 of them will be just about surviving, will give you 1 to 2x return. 2 to 3 will probably just disappear. But it's that 1 or 2 which will give you that 100x return. And this is hoping you have made a wise decision to invest, right? If you've just randomly invested, it could just be all be zero, which is what I warned you about, Saujanya, right? That you have to be prepared for the worst case, and you should be comfortable with losing everything. But hope for the best. I mean, everybody invests hoping for the best, right? So just take that informed risk.
So first thing is identifying 10 big hitters, and from that expecting that, okay, out of this 10 I probably will potentially see 1 or 2 which will really be big hitters, but the others are going to be my bets as well. And being okay with that. That's
very important. Yeah. And that 10 should not, you don't have to do it all at one go. You start with one, but within a reasonable period of time, you have that portfolio. You don't do one started, one folded, then next investment that went nowhere. No, just try and pace it well.
Got it. It's like building a wardrobe, a niche wardrobe.
It is, yeah. That's a great example, right? Some
you might put on weight.
You'll get ROI like crazy. Some you'll have it just because you liked it and never really used it.
So, what did you go through when you didn't make the money? I mean, mentally, tell me a little bit about that anxiety. What to expect there?
Yeah. No, so the first time I was shocked. I told her, I was like, what? I just wrote the check and they are telling me that it's folding. I was shocked. And that's when I did that introspection. What all did I not do that I should have done? And then spent time learning about it, listening, being part of the ecosystem, understanding. And only very recently, so I've not crossed that 3-year mark where I should start to see some exit. Fingers crossed.
Following you. I'm right behind you. I want to understand a little more in terms of one of the things I've found very helpful talking to mentors is understanding who to follow and who to network with. And I think while you talked about where to go look for this investment, three that you listed early on, can you give some indicators of who are the right folks that you follow on Twitter, or business analysts or analysts that you follow? There are great reads to stay abreast.
I'm a very unsocial media person. But what I do is I read a lot, right? So that's really my go-to in terms of whenever there's an interesting art. I always read the startup pages that come in the leading newspapers, right? Just so that you get a sense of what's happening in a diverse industries, because you get a sense of that. I always join the call with founders.
Okay.
Because there are multiple investors who join that call, and more than anything, I learn from the questions that they ask.
Very interesting
Right?
questions. Yes.
People ask questions I wouldn't have even thought of,
Yeah.
and that's how I learn.
Yeah.
Right? And I mean, I really don't have any particular investor, anybody that I follow as such, but all the people, I listen to them and just see. Of course, there are some marquee names, but I'm like, how does that help me if their startups? I don't have access to investing in the startups they are investing in. So how does it help? Because
But for industry trends or global mega trends,
just read. I'm an avid reader. I keep reading all the time. So read. Today there's a lot of information available. So what I do is, right, let's say I get a deal that this company is looking to raise investment. What do? I just go quickly research first about the company on the internet, what's available. Then I look up what is happening in this industry, right? I try and see if I know someone who works in that industry from my friends group or someone I know. I reach out to them, and all this is before the call with the founders, right? Just go and do my homework and say, do you think this problem is real? I ask them, people who work in that industry, who is solving it for you currently? What are the challenges you face with the existing vendors or the existing solution providers for this? And then, that gives me a little bit of sense of what I'm going to look at. And then when in the founders call, you hear them,
the rest of
it, and then you just take it. A lot of times, end of the day, it is your gut feel. But it's a gut feel which is based on information.
Yeah. And when it comes to the founder networking or the startup ecosystem networking, is that where the work complements it, or do you also go beyond that? For someone who's not like heading global NetApp accelerator program, where do I go and build that?
I think that today in India, there are a lot of these industry bodies for startup ecosystem. Like there's TIE, which has the Indus Entrepreneurs, TIE. They have local chapters. Join them, right? Go and listen. Nowadays, most of it is virtual. Listen to, the panel discussions. Listen to the speakers that they invite. Various topics, very informative. Very good quality speakers that come. Go to these founder calls. You don't need a network. You just need to be part of one such platform to get access to that. And pretty much, right, over time you develop this. Once you've made some investments, keep connected with the founders there. Understand what's going on in their journey. How can you help? Right? That's very important to have that mindset, because then they'll reciprocate, and you will learn and you will understand and observe that journey. And I always think, see, investing is it's like a marathon. It's not a sprint that you've invested quickly, you gain the money and then that's it. Slowly, just invest that time. So yeah.
But be consistent also.
Be consistent. That's very important. So TIE is one such. Then these other platforms where you can just go and see what's happening. Connect with other investors, right? You can discuss if a couple of your friends are investing in a startup, you all can connect and understand what's happening. Yeah, pretty much.
No, I found it very useful. Like, I reached out right after saying, hey, Madhurima, I want to catch up for coffee. And I think every time I've spoken to both Kalpana as well as you, I've learned a lot more. And as I go into these cohorts and I listen to questions, like you said, sometimes I'll be like, wow, I didn't think
Yeah.
of that itself. Wow. Um,
That's
and then you can
always
see
there.
how it correlates with some of the numbers that they're showing or the projections. And you're like, yeah, I didn't think of how these sort of, complement each other to understand. So I think it's the first plunge, is what you're
Yeah.
saying. Take the plunge.
You have to. That's the best way to learn.
Any parting advice?
No, I think, build that corpus.
That's a starting point. No, I think even
That
before
is-
building the corpus, play
Yeah.
around with this to understand.
Yeah,
Right?
so always be very inquisitive, be curious.
Yeah.
Be open about learning, and be open about saying, I don't know, tell me more.
Yeah.
Right? That's where you start. And once both of these are there, take that risk, have fun on the ride.
Well, thank you so much, Madhurima. You've onboarded me onto a new journey, and I hope this conversation onboards quite a few more of my listeners also to really enter the space. Whether they invest or not is secondary, but to just expand their knowledge and understanding of the ecosystem and thereby their own mindset. So thank you so much.
Thanks for having me here.
Thank you.